Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. And joining me today would typically be the governor of Texas himself, Mr. Michael Becker, but he is on another due diligence assignment, and we wish him the best. So sitting in the podcast today, the professor, Mr. James Eng. James, how are you?
Great. Thanks for having me, Paul.
So, James, tell us a little bit about some of the things that you are pushing out to some of the people that are wanting to learn a little bit more about financing apartments throughout the nation.
Yes, I think we push out a lot of information, but I sort of put together a concise 3 or 4 attachment email that essentially will give you everything you need in sort of one quick bite. And what I found is when people are able to review that information and then we set up a phone call and really go through it in detail and answer their particular questions, it's a lot more beneficial for the potential borrower. So we send out our 17-page white paper, we send out a PDF on sponsorship groups, and then also an FAQ that we put together that answers your most common questions about multifamily lending. And then the fourth thing is really the webinar. So 3 webinars all around Fannie Mae, Freddie Mac, and then also the loan process in detail when you're going through an acquisition or refinance.
Yeah, some great information that James has. Don't forget to go on to the Old Capital Podcast, and that's where you're going to find a lot of that information. Also, too, is that if you think that we provide good quality information, go on to iTunes and leave us a 5-star rating. We would certainly appreciate that. I think we have a couple hundred 5-star reviews, but we need yours and maybe a comment or two. So we would appreciate that and some great information that James puts out. You know, talking about James and your information you put out, James has written a white paper report. So the professor has written a white paper report. I thought we would want to cover that a little bit today and give an idea of some of the ideas that are out there. So let's kind of talk about your white paper report, James, and tell us a little bit of where the genesis of this report came from.
Yeah, so I was listening to an investment panel, and sometimes it's good to listen to experts in fields outside of real estate to sometimes appreciate what you have here in multifamily. And so this particular investment panel was around people who invest in businesses, more specifically Amazon businesses. So there's a lot of transactions, a lot of retail is moving on to Amazon, and there's a lot of businesses built around that. So what I'm going to cover today is really the 4 key lessons that I saw listening to that panel, and then also after reviewing those 4 lessons, really go into the acquisition, asset management, and disposition process for multifamily investing and talk about some of the key things that I heard in this panel.
So let's talk about the 4 lessons, Amazon business buying versus multifamily investing. So number 1, attention and differentiation.
So the key thing for this theme of attention and differentiation is really nobody can sell anything on Amazon unless you have the customer's attention first. And so in this business, a lot of people can search on Amazon, but unless you have the attention of that consumer, it doesn't really matter. And once you have the customer's attention, then how do you differentiate yourself? So when they go on to Amazon and search for a specific product, how are you the first one? The same way that it used to be on Google's, you wanted to be on page 1. It's very similar on Amazon. And so when you apply that to multifamily, there are a lot of buyers who are trying to buy B and C multifamily in your market. So how are you getting the attention of, let's say, listing brokers when you're trying to buy a property, but then also once you buy the property, you as the owner, how are you gaining attention for your specific property, right? So how are you changing the visibility, the curb appeal, and the tenant experience? Are there other people, are your tenants talking about your property to other potential tenants, right? And then when you actually go to sell the property, how is that listing broker going to actually provide attention to your property? How many buyers do they have in their database? Who are they going to put the deal in front of to find you a good buyer? So you not only have to have attention, but then you have to differentiate yourself throughout the multifamily process.
Number 2, rating and reviews, they do matter, right?
So I feel like whenever I buy anything, I have to check the reviews on it, everything. So I'm just walking through the store, and before I even buy it, I'll go on Amazon, check the reviews on it.
Yep.
And in multifamily, there's not necessarily a place for ratings and reviews. It's a little bit more informal. But when you interact in a transaction, and whether it's the listing broker or the property manager or your investors, everybody asks everybody else, how is it to work with that person? Would you recommend that person? So at GE, we used to have a thing called Net Promoter Score, and we would always ask the question on a scale of 1 to 10, 9 or 10 being the highest, would you recommend this product or would you recommend this person? And that's a very key distinction. You actually get a lot of surveys from restaurants, and that's the one question they ask. And that's the one thing that they measure is, did we do enough in our service delivering our product to get a 9 or 10? And if they didn't, then what do we need to be changing to do that? So you as a buyer, when you're going through a transaction, a lot of times we'll see buyers get hung up on very small items, and they can get into the minutia of a deal, whether it's a $10 million deal or $20 million deal, and it could be, a couple $1,000s that they're fighting over. And a lot of times it's just not worth it. And at the end of the transaction, we always like to say, would you want to do another transaction with that buyer or with that seller? And if the answer is no, then your ratings or reviews are definitely not going to help you do more and more business in this multifamily game. So it's a small community. And even in a large MSA like DFW, people talk and people want to work with people who, say what they're going to do, and they're easy to work with. And so ratings and review definitely matters.
Definitely. Number 3, buy versus build.
So this was interesting because a lot of the people on the panel, they were entrepreneurs. They brought something from nothing and sort of built it up. It took them 2, 3, 4 years to develop, get selling on Amazon. They were maybe selling $1 million worth of product, and then they got it all the way up to 10 million, and then they sold their business, right? But it took them 4 or 5 years of their lives to do that one project. And so once they had an exit, they actually had money, and now they started looking at investing in other in other businesses. And so the same way that there's developers who will spend 2 or 3 years developing a project and then selling it, these people were actually, instead of developing, now they were investing in place businesses. So the same way that there's people who develop multifamily and there's people who just invest in A, B, and C class in place properties and improve them, that is actually where they found more value. So they were able to get a quicker return when they were able to look at a business and see the potential in it, right? So the same way that when you drive by a property and you see deferred maintenance and the sign is fallen down and they haven't done any interior upgrades, the same way these people were looking at Amazon businesses where they might have had one channel to sell through. So they maybe had a email list or distribution list, but they weren't advertising, let's say, on Facebook or Instagram. And so being able to access multiple channels was sort of like the value add play that a lot of these investors were seeing in different businesses. And so I thought it was interesting because you can develop multifamily, but a majority of the investors that we work with are investing in in-place deals where they see the upside and there is a value add play.
Number 4, recession proof.
So towards the end of the panel, they really talked about, well, this is the 9th or 10th year of the expansion. And what are you going to do in this environment if there is a recession, right? So as a larger percentage of people really start to buy more stuff online, they really saw that there was still more upside in investing in Amazon businesses, the same way that people see that there's been a shift to renting to multifamily, especially with higher interest rates, higher cost of single family housing, and then also just the demands of being able to move after 2 years, let's say, living in a place and being able to move without having to go through the transaction cost of a single family home. And so they were definitely positioning themselves to be in more recession proof products. Like the easy example they used was, deodorant versus fidget spinners or any sort of thing that is hot this month versus next month. And so investing in things like BNC multifamily were very similar in that they're essentially recession proof and they give you, constant cash flow throughout the process. And so I thought it was interesting to hear that. And then also a lot of times they were saying, well, we need to make sure that this business last through the recession. So cash flow, and then I would say on the multifamily side, long-term debt, making sure that you do not have a maturity in the middle of the recession.
So having a long-term horizon definitely is recession-proof, that you can survive through problems. So multifamily investing is a business and should be treated one, just like show business. Without the business, there would be no show. And the same thing comes with multifamily. It's always interesting to hear the pros and the cons of other business models, and sometimes points out the beauty in our business and multifamily.
Right. And the one thing that stuck out to me was a lot of these businesses, they sell a product. And if you, let's say you sell, I think a couple of years ago, the Snuggie was a big seller where you essentially had one sale and you were done, right? You have one ugly sweater and that was the only ugly sweater that you were going to buy. But the model of having a monthly subscription model gave a premium to these businesses. So if you had a monthly subscription model that you could build in where you knew that you were going to get like a Netflix or Hulu or even a cable TV model where you knew you were going to get monthly, those traded at a premium. And then the beauty is in multifamily, we already have that built in. So we get the rent's due on the first, as they like to say. And so multifamily has a huge advantage just already having that as part of their business model.
Can you give me some more tips on the investment cycle?
Yeah, so I wanted to now, so those were the four sort of major themes that I saw throughout the panel. But then there was actually some things throughout the acquisition process, asset management process, and disposition. So I want to start with acquisitions and a couple of the key things that I saw. First off was know your buying criteria and purchasing power. So when they were looking at deals, understanding how much capital they had to spend, sort of what their risk tolerance was. And then it was actually interesting because there was, at certain levels, a business is investable. And so some businesses were just too small. And the same way, some multifamily properties are just too small to invest in. And so when you buy, let's say, 10 units or 20 units, you're not necessarily buying a business at that point if you physically have to be there. And so a lot of these businesses, it was more of a revenue cutoff. So if you weren't generating enough revenue as a business, nobody was going to invest in it. And so understand your buying criteria and purchasing power so that when you're going out there and you see a listing, make sure, all right, how am I going to manage this property? Can it afford third-party property management? Am I going to have to manage it? So understanding where that is, but then also who your competition is at that buying level. And so let's say in Dallas, I would say the $5 million to maybe $20 million range deal size is where a lot of, I would say, syndicators are doing very well in that space. But once you get above 20 million, maybe 25 million, that's a whole different ball game in terms of institutional quality and institutional capital. And so their level of their cost of debt, their ability to come in with $500,000 to $1 million hard day one is very different. And so understand sort of your criteria and what you want to buy, but then also who your competition in that space is.
What I find interesting is that when folks buy 10, 12, 15 doors, I mean, that's really not, you're not buying a business. It's like buying a medical practice and spending, $1 million to buy a medical practice and find out when you walk in there that you only have 5 patients or 10 patients. I mean, to have a viable business, you need to have 100 doors or 150 doors or 300 patients or so, something that's going to have cash flow over a period of time. But a lot of people just start off buying these small little properties, and the economies of scale just don't make them work.
Right. So number 2 was know your role. And so a lot of these investors were limited partners, and then they invested into general partners, right? But then what we like to say is understand who the pilot is or the co-pilot, and then who are the passengers. And a lot of these investors were just the passengers, and so they had to sit in from the back and watch. And so make sure to know your role in a lot of these deals, because what we find sometimes is general partners will talk to limited partners, and limited partners sometimes want to be a general partner or ask as many questions as a general partner. And so make sure you know your role in these transactions, especially if you're a key principal. When these deals are going to closing or getting close to closing, you have documents to sign and notaries to be had. So please know your role throughout the transaction and know what you're signing up for and what you're providing. And I think that's a key thing is a lot of people, when they first getting started, they'll look at their role as a limited partner and not think about their transition to a general partner or KP. And so what I've seen is sometimes if you're going to invest as a limited partner, sometimes it's a better idea to invest with a potential GP that you would partner with in the future. Mm-hmm. And make sure that you start working with that person, and then you can almost make an investment of $50,000 or $100,000 in one deal with that person before you get into a marriage / a partnership with that person for the next 5 years. As a limited partner, you get a good understanding of, how they're going to communicate in terms of monthly reports, how they work with the property manager, and then how they work with actually their other investors. And so I think that's a good starting point for a lot of people, is to start as an LP in a potential sponsor's deal, and then going forward, you could potentially partner on a deal.
So less pilots and less passengers, typically the communication is easier.
Right. And sometimes you'll have multiple co-pilots to meet sort of the net worth and liquidity requirements, but you need to figure out a way to communicate to these investors, because a lot of these deals, especially as they get larger, you might have 40, 50 different investors on your deal. And so from my point of view, general partners, I have some general partners that I've invested with, and they communicate quarterly, and some monthly, and some weekly. And I would say, even if the property isn't performing perfectly to the pro forma, the general partners who communicate more often, you have a comfort level with them. And on their next deal, I feel more comfortable investing with them, just because I know that they're on the property, they're working the property, and they're understanding, working through any issues that come up. Whereas if you communicate quarterly with your investors, I feel that's just not enough. There's too much of a lag between what's actually happening on the property and sort of day-to-day management, that I think you should at least try monthly to communicate with your investors.
Know your investors' risk tolerance.
So on the panel, they were talking about marijuana on this deal, and there's a lot of opportunity in marijuana. And, as they legalize it across many states, there's a lot of growth opportunity. Mm-hmm. So there's a ton of upside, but a lot of the guys on the panel were just older guys. So they were, in their 50s, 60s, and all their investors, that is not what they want to invest in. They don't understand it. They don't want to be a part of it. And so you have to, the same way that, let's say you've invested in every deal that you've done has sort of been, let's say a B quality product in a B or A minus location. And then all of a sudden you say, well, that's getting too bid up right now, and there's a little bit more opportunity in, let's say, a C class property in a C area. And, my advice to some investors have been, will your investors go with you to that area, right? Will they go from the good side of the tracks to the bad side of the tracks? And even though there might be more opportunity and a little bit more risk, you have to make sure that you know your investors' risk tolerance, because you do not want to get under contract on a deal and they come back and say, well, I could only raise half the equity, and you lose your earnest money at that point in time. So make sure, and I know some general partners will do this, they will put sort of feelers out to their investors before they go under contract to just make sure that that's a property that they want to invest in, and make sure that you're able to close any gap in the equity with your own liquidity.
Surround yourself with a team of professionals.
Right. So a lot of times, and we've seen this on a couple deals where the seller will send over, let's say, the title commitment or the contract and the survey and some of these things, and have your legal team actually review it. And this is almost a key point where when people have tried to buy some of these Amazon businesses where they're using their family's attorney or they're using the most expensive attorney as if they're negotiating a contract with like Goldman Sachs or something, versus somebody who knows the industry. And so when you bring in your attorney who's like a family attorney that's a best friend, but they've never done a real estate deal, it looks very unprofessional. And so you want to know who the people who have done real estate transactions, how many deals, if you're choosing a lender, how many deals have they done in Dallas or necessarily in Texas with your type of loan, right? So use somebody who speaks the language, understands the industry, because a lot of times you'll be flushed out just because of who your attorney is. So we've seen attorneys mess up deals, and you want to make sure that you choose an attorney that understands the real estate business.
Yeah, there are attorneys out there that are deal makers, and there's attorneys out there that are deal breakers. As much as that rhymes, it's absolutely true, because there are some groups on the selling side that will not work with a person who is not consistent in doing multifamily properties. How do you differentiate yourself in a crowded market as a buyer?
So a lot of deals right now, I would say it's not 30 bids on a deal, but there might be 10 bids on a deal. And so every single point, the same way that businesses have to differentiate themselves, you as a buyer have to differentiate yourself. And so whether that's hard money, whether that's providing, a resume that shows that you own in that area, whether it's proof of funds. I mean, a lot of people right now are 1031 buyers. So showing that, look, I already have the $2 million in the bank ready to go. And then also here's the debt quote of $8 million. I can buy your $10 million property in the next 30 to 45 days is very strong, because equity is getting more and more difficult to raise. And so differentiate yourself up front as a buyer is key.
I mean, you always want to make sure you work with a mortgage broker who speaks the same language as bankers and can negotiate the best terms for you. You just don't want to have a residential loan officer become your commercial mortgage broker. You want to have somebody that this is what they do on a day in, day out basis. And we can't say enough of how much James does that for his clients. Working capital challenges.
So we're lucky. Well, a lot of businesses, they have to buy the inventory and then sell it. And so a lot of businesses, even though they might be successful, they might go on to Shark Tank and have, 10,000 purchase orders for their product, but all of a sudden they have to fulfill that product. And so there can be an issue with cash to actually buy the inventory. And so that was one of the challenges that they pointed out in a lot of these businesses, is that they couldn't grow it without the capital. And so the same way that a lot of multifamily owners, if they've owned the property for 5, 10, 15 years, and just the level of deferred maintenance, the level of capital that they have on hand to upgrade units or cure deferred maintenance is not there. And so when you come into a deal, making sure that not only your property capitalized, but then after closing, doing the rehab, making sure that you have enough liquidity at the partnership level, I think is key, because a lot of these loans that we're doing are 10 years or 12 years. And a lot of people are pushing out distributions too early and too fast. And so making sure that your rehab's done, making sure that you have sufficient liquidity so that if there's an issue with the chiller or the boiler, or there's a large claim on the property, you have the money to take care of any issues that pop up, because that is sort of what starts the downward spiral.
That was
one
of the biggest things. Is capital was not put into the property at the beginning. People thought they would cash flow the property and then try to stick money into these properties. but that didn't seem to work. It was a failing method back 10, 15 years ago. So if you do have capital, put in the property up front and borrow that money to put money into the property to make money in the future. So funds versus deal by deal equity raise.
So this was interesting was because there were some investors on the panel who actually just raised a big fund. Let's say they go out and raise $20 million, and then they gave the discretion to the general partner to buy whatever property that they wanted to buy or buy whatever business they wanted to buy. And the point that one investor made was, I raised my money deal by deal. And so you know exactly what you're going to get. And it actually, to him, he actually felt like it actually gave a little bit more scrutiny to each one of his deals. Because if he was going deal by deal and one of the deals didn't raise as quickly or didn't perform as well during that equity raise piece, he sort of knew that that probably wasn't that strong of a deal for his investors. And so I thought it was interesting, and a lot of people that we work with typically raise deal by deal, just because once you have a fund, there's a lot more pressure to get the money out because you're either paying money for that funds that have already been committed to your investment.
Yeah, investors lose control once they put the investment into a fund. So build checklists for everything.
There's a book that I read a couple of years ago called Checklist Manifesto, and they just said, and essentially even the smartest people in the world, even doctors who are doing surgery, they have found that just putting together a checklist for whether it's surgery or prepping for different things where it's literally life and death, have saved millions of lives at different hospitals. And so if for things that are that important, I think it's just as important so that when you start, whether it's the loan process or your acquisition process, having a checklist so that you know step by step what you actually need and what you've done and what you haven't done. Because what I found is that every deal is a little different. So where something doesn't, let's say title doesn't bite you on this deal, but on the next deal it does bite you. Or environmental was an issue on this property, but it isn't on this one. You have to sort of build a checklist, especially as you start underwriting more and more deals, because sometimes you get confused. I wouldn't say confused, but just
deal merge,
and you just can't remember everything. So it's good to have checklists.
Pilots who are flying airplanes before they take off go through their checklists. Pilots that are landing airplanes before they land have checklists, so they don't forget step 17 out of a 100-step checklist. That number 17 was put down the flaps, or take up the flaps. So that's an important thing. So you got to have checklists in multifamily properties too.
Yeah. So I would say every acquisition you do, or even every underwriting that you do, remember those things that you forgot so that you're stronger on the next one. Yeah,
you do it once, you won't make that mistake again. So there's no doubt about that. So we talked about acquisitions. Let's talk a little bit about asset management.
So the first thing was the same way that we don't want you to buy a property and you just self-manage it day one, and that's the only property that you're ever going to own. The same way these businesses, they hire third-party management. So they hire professionals to manage these businesses, because if you do not, it becomes very difficult to scale up multiple businesses and run multiple properties. And so they use third-party property management.
It's not a problem if it's maybe a small property. You're trading your job for another job that you're probably, if you're making $100,000 and you want to manage a 10 or 15 unit building, that you're probably going to make $20,000 or $30,000. If you want to do that, that's fine. But when we're providing financing for these 100, 200, 300 unit buildings, you definitely don't want to come out of the box and become your own property management company. You want to hire a third-party property management company. Also, let's talk a little bit about cash reserves for a dip in occupancy.
Right. So they mentioned this, as they see a recession looming, that the same way they want cash reserves, because a lot of these things are actually going to become, let's say there is a recession, some people are going to not spend as much, let's say on Facebook or Google AdWords, and that might be a time for you to sort of take over the market for that particular category. And so the same way you want to not only be defensive, but also offensive in terms of being on the offense on a lot of these properties. And so, cash reserves in case anything comes up is key on the asset management side.
And then you got to have larger CapEx for larger properties. I mean, one of the things that Michael Becker talks about all the time in these older C properties that you think they're just recurring, non-recurring expenses become recurring expenses, that will dwindle your cash away really quickly. So the biggest one, I'm going to pound the table on this, which I absolutely think is run a property as if you are never going to sell it.
So what's funny is at the very beginning of the panel, they were like, a property is never sold until it is sold. Just because it's under LOI doesn't mean anything.
Right.
Just because there's some money down on the table doesn't mean anything. It's not until that last cash or that last check comes through or last wire comes through. And you need to think long term about the health of your property, because a lot of these deals, especially we've seen it where sellers have filled up the property with a bunch of people. So the occupancy physically is there, but then none of those people pay.
Nope.
And they go away after a couple months. And so just because you think you're going to sell the property, you need to make sure that you are still investing in the property, still taking care of any deferred maintenance as if you're never going to sell it, because that actually puts the property in the best position and you actually get the highest price.
Yeah, a lot of these investors in the last, say, 5 or 6 years have only been focused on trying to acquire the property, rehab the property, and sell it as quickly as they can to make as large as a capital gain as possible. But I look at tax rolls to kind of figure out how long did this seller own the property, and how long did the seller prior to that own the property, and how long did the prior seller own the property too. So you may have back to back that people continue to acquire and rehab the property and sell it. I mean, I think that could be good in a short term, but I think right now you got to think about owning a property that you're never going to sell it, and you have to be as efficient as possible in operating these properties. So, cash flow is king, and just make sure that you continue to cash flow these properties and put money back into the properties themselves. Do not try to put money in and then try to take it out as quickly as you can. Incentivize the staff.
So this last one for asset management was really around not only giving people, let's say the property manager, a salary plus a bonus, but then anniversary bonuses, because, maintaining these properties, you have a $10, $15 million property and you have maybe 4 or 5 people on staff, and they are your eyes and ears there every day, making sure that your tenants are taken care of. So making sure those people are paid well. And if there is a gap, I mean, we've seen this a little bit better on third-party property management, where for whatever reason the maintenance person leaves or the leasing agent leaves, being able to fill that gap quickly. We ran into an issue where a person was self-managing and their occupancy dropped from 95% to 80% because they were not rehabbing units, because they were waiting on one guy to come back to rehab the units.
Oh, boy.
Yeah. So if it was a third-party property management company, you would have had somebody in there right when those units came available to turn the units, rehab them, and get them up for lease. And so making sure that you incentivize your staff, the staff that you have at your properties, is key, not only while you own the property, but then also through the disposition process.
Well, let's talk about that, because we've talked about the acquisitions, what you should be looking for in the acquisitions. We've talked about, asset management, run the property if you're never going to sell the property. Look in terms of the long-term health of the property to make it a more attractive property for the sale. But now let's talk about the sale itself and the disposition of the asset.
So I'm going to jump around to the deal is not closed until the final check clears. And that is becoming more and more relevant, because a lot of these deals, they used to close in 45 days, maybe 60 days, but now it's being stretched out a little bit. So it might be 65, 75 days, because there's a couple things at work. Number one, interest rates are moving around. So there's been a lot of volatility in interest rates, which is causing some people to have lower loan proceeds. And what that translates into is more equity. And
more equity needed
down on the transaction to close. And so that's taking a little bit longer, as the returns are being a little lower than people are used to in the past. And so you have to keep running that property as if it was not really even under contract. And you need to keep, the main thing is net rental collections high, and then also making sure that, other income, and there's no large CapEx items that when the lender goes out and takes a look at the property, that they highlight. And so deal is not closed until that final check clears.
So most people have a price on a property.
What's interesting is, most people have a business plan, and once they hit it and hit their target returns, they're usually available to sell because you typically just don't have enough money to take it to the next level. And so similar to multifamily, a lot of these entrepreneurs, they had businesses and it was like a one-man business and out of their garage, and they had maybe grown it to $1 million in sales a year, but taking it and getting a contract with, typical Shark Tank example where getting a contract with Bed Bath & Beyond or one of these large vendors and all of a sudden getting a huge order, there's a lot of risk when you go from just sort of your $1 million in revenue to a $10 million or $20 million in revenue business. And, most people just can't get it to that next level. And so the same way that we'll see a property and the rents are below market by $100 or $150, and you're saying, well, why doesn't the seller just put another $500,000 in the deal and upgrade all these units? And typically they don't have the money. So they're going to have a price on their property. So most people have a price that they want to sell for, and you just have to find out what that price is.
When you sell, do you use a professional broker?
That's what's interesting is a lot of these businesses, some of the buyers said, I will not buy direct from an owner. They had to be professionally marketed, professional, because a lot of times, the owner they're providing all the information, but, the professional broker will take all the information and put it in a package, sort of vet the deal up front and make sure that this is a real deal. And they actually have the financials and the backing. So the broker's reputation is at risk a lot of times. And typically there's a lot of sticking points on these deals where the broker can sort of massage, or not as a massage, but just be able to articulate what's going on in the market. Whereas if you're talking direct to the seller, sometimes that's a little bit harder to get through. And a lot of times when it's listed by a professional broker, you actually know the business or the property is going to sell. A lot of times you take an offer to a seller and they just sit on it and you don't get anywhere. And so definitely use a professional broker. If you're a seller, it helps tremendously, especially let's say you're going to sell a property in the next 6 to 12 months. Make sure a broker sort of gives you an opinion of value, a BOV, but then ask them, what else should I be doing or what shouldn't I be doing, right? And so if a property, necessarily needs to qualify for green, maybe it's not the best time to do all the toilets on a property. Or, if there is some, large CapEx items in your financials, how do we report that correctly? So cleaning up your financials so that when it does go to market, it's a clean deal, clean financials, clean property.
I would also comment on that, saying loyalty brings more business. And if you bought the property through broker X, Y, and Z, and now you're looking to sell the property, I would bring it first back to X, Y, and Z and let them try to sell that deal for you. Would you agree with that, James?
No, I think it goes back to sort of attention, but then also differentiation, depending on what you can bring to the table. I mean, brokers make their living on selling deals. And so if you're able to feed them a little bit, then they can definitely help you find your next deal.
Well, that's the professor, Mr. James Zhang, on the white paper for this quarter. And I thought James did a great job of kind of wrapping it all together. We talked about the acquisitions, we talked about the asset management, and then talking a little bit about selling the property, and just more of a kind of a big picture, and using like Amazon as a platform and making the jump over to multifamily and what we do and what you want to do in multifamily. So some great dialogue, some great information, James. Anything more to add to that?
No, I mean, I think